Hello, and welcome to our weekly global briefing. I'm Chris. We are looking back at the week of March 16th through the 20th, 2026, a 5-day stretch that will likely be remembered as the moment the post-war energy order finally fractured. If you've been watching the headlines, you know we aren't just talking about market volatility anymore. We are talking about a fundamental shift in how the world powers itself and how it pays for that power. The week began with an atmosphere of extreme tension. By Monday, March 16th, the conflict in the Middle East had moved from localized skirmishes to a systematic assault on the world's energy jugular. The most devastating news came on the 18th and 19th, with coordinated strikes on Qatar's Ras Laffan industrial city. For those who don't follow energy infrastructure closely, Ras Laffan is the heart of the world's LNG supply. Qatar Energy has since confirmed a staggering $26 billion in physical infrastructure damage. But the financial hemorrhage doesn't stop at repairs. We are looking at a $20 billion annual revenue loss for Qatar and a multi-year timeline just to get their primary export trains back to 50% capacity. When Qatar declared force majeure on Thursday, the global manufacturing sector effectively held its breath. In response, Brent crude didn't just rise, it exploded. We saw intraday spikes touching $120 a barrel before settling near $115 by Friday. The political fallout was immediate. Here in the United States, the Pentagon has pivoted to an offensive posture to keep the Strait of Hormuz open. Defense Secretary Pete Hegseth has gone to Congress with a request for $200 billion in emergency war funding. The narrative from the Trump administration has been clear. Energy independence is no longer a policy goal. It is a national security requirement. Washington even issued a temporary waiver to the Jones Act this week to facilitate domestic shipments, a move we haven't seen used this aggressively in decades. Meanwhile, Japan and several European nations have begun a record emergency stock release, coordinated by the IEA, as they scramble to replace the barrels and gas lost to the Persian Gulf blockade. This week, energy wasn't just a commodity, it became a weapon. Moving into the broader economy, the data we received between March 16th and 20th confirms that we are entering a period many are calling stagflation 2.0. On Wednesday, the 18th, the Federal Reserve faced its most difficult interest rate decision in years. Despite the chaos in the Middle East, or perhaps because of it, the FOMC chose to hold rates steady at the 3.5 to 3.75% range. Chairman Powell's press conference was a masterclass in caution. He acknowledged that while core inflation showed signs of cooling earlier in the year, the energy shock has effectively reset the clock. The Consumer Price Index report released mid-week showed a 2.4% annual pace for February, but those numbers are now considered pre-war data. The market is already pricing in a massive inflationary spike for the March and April reports. The bond market reflected this anxiety immediately, with the 10-year Treasury yield climbing as investors sought safety, pushing mortgage rates to a 3-month high of 6.22%. What we're seeing is a widening divergence between the U.S. and the rest of the world. While the U.S. attempts to shield its consumers with domestic reserves, the Eurozone is facing a much darker reality. Bulgaria officially adopted the euro this week, becoming the 21st member of the Eurozone at arguably the most volatile moment in the currency's history. In the East, China's economic data released on Monday showed industrial production and retail sales for February were already softening before the energy crisis hit full tilt. The global manufacturing PMI is now in a free fall. The takeaway for the week of March 20th is that the soft landing everyone hoped for in 2025 has been replaced by a hard reality. Capital is fleeing emerging markets and moving into what we call fortress assets, US dollars, gold, and increasingly a digital alternative we will discuss in our next segment. While the traditional equity market spent the week in a sea of red, the digital asset space told a completely different story. This week, from March 16th to March 20th, we witnessed what many analysts are calling the Great Decoupling. Bitcoin started the week strong, reclaiming the $72,000 level on Monday. But as the news of the Qatari strikes broke on Thursday, we saw a historic move. Bitcoin surged past $109,000 in a matter of hours. This wasn't speculative mania, it was a flight to safety. For the first time, institutional desks were treating Bitcoin not as a high-beta tech stock, but as digital gold that is immune to the closure of physical shipping lanes. The Fear and Greed Index for crypto remained stubbornly low at 15 for much of the week, a sign of extreme fear, but the price action was aggressively bullish. This divergence suggests that the smart money and sovereign entities are the ones doing the buying, while retail remains paralyzed by the headlines of war. It wasn't just Bitcoin making waves. XRP saw a massive fundamental victory this week as it received a formal digital commodity classification. This has huge implications for cross-border liquidity, especially as traditional banking rails face pressure from geopolitical sanctions. However, by Friday the 20th, we saw a slight retracement as liquidations hit leveraged traders, with Bitcoin cooling back toward the $70,000 mark. The volatility remains extreme, but the narrative has changed. This week proved that in a world where you can't move oil through a strait, you can still move value through a node. The infrastructure for institutional ownership has never been stronger, with BlackRock's Ethereum ETF, the ETHB, seeing record inflows in its first few days of trading this week. If the energy sector was defined by destruction this week, the AI sector was defined by rapid, almost dizzying construction. March 16th marked the start of NVIDIA's GTC 2026 conference in San Jose, and Jensen Huang did not disappoint. The focus has shifted entirely from chatbots to physical AI and AI factories. NVIDIA announced a massive deal with Mira Murati's new venture, Thinking Machines Labs, for a gigawatt-scale compute cluster. To put that in perspective, that is enough power to run a small city, all dedicated to training the next generation of world models. We also saw the release of GPT 5.4 and Claude 4.6 this week. The headline here isn't just smarter responses, it's agentic AI. We are moving into the era where AI doesn't just suggest a trade or write an email, it executes the entire workflow. Hexaware launched Agentverse this week, a platform featuring over 600 ready-to-deploy AI agents for enterprise use. But it wasn't all progress. A major scandal unfolded as the U.S. Attorney's Office began investigating Supermicro. Allegations have surfaced regarding the smuggling of high-end AI chips to restricted regions, highlighting the growing silicon curtain between the West and its competitors. On the policy side, the Department of Energy announced $293 million in new funding under the Genesis mission to use AI for solving national scientific challenges. At the same time, the Senate is pushing new legislation to curb the Pentagon's use of AI for domestic surveillance. This week made one thing clear: AI is no longer a subsector of tech. It is the new base layer of the global economy, but its growth is now hitting a physical wall: the availability of the very energy that is currently under fire in the Middle East. To wrap up our report for the week ending March 20th, 2026, we have to look at the political shifts that are driving these markets. In the United States, the political atmosphere is electric. We saw Zohran Mamdani sworn in as the mayor of New York City this week, marking a historic first for the city. But on the national stage, all eyes are on the brewing conflict. The Trump administration's engagement with 7 key nations regarding the Strait of Hormuz has dominated the diplomatic cables. There is a palpable sense that the U.S. is preparing for a long-term engagement in the region to secure energy transit. Globally, we saw significant leadership changes. Vietnam re-elected To Lam, and in a move that startled many, Mojtaba Khamenei was announced as the new supreme leader of Iran, following the reported assassination of his father. This leadership transition in Tehran is the X factor that could either lead to an escalation of the energy war or a desperate opening for a new deal. In Europe, the political map is also shifting. Bulgarian President Rumen Radev resigned, paving the way for Ilyana Iotova to become the country's first female president. Meanwhile, the UK is still reeling from the political fallout of the Peter Mandelson scandal, which has further weakened the Labour Party. As we look toward the final week of March, the questions are clear. Can the U.S. and its allies successfully reopen the Strait of Hormuz without sparking a global depression? Will the energy-gated economy lead to a permanent higher floor for inflation? And will the AI revolution continue its breakneck speed in a world of limited power? This has been your weekly briefing for March 16th through the 20th, 2026. I'm Chris. Stay resilient, stay informed, and I will see you in the next update.